Welcome to the Credit Events Podcast, a podcast for credit-savvy investors. This podcast is for informational and educational purposes only and does not constitute financial advice. The opinions expressed by the presenters are their own and do not reflect the views of Destra Capital. Nothing discussed in this podcast should be considered a solicitation to buy or sell any securities. Listeners are encouraged to consult with a qualified professional before making any financial decisions. And now, here's your host, Rob Watson.
Hello, everyone, and welcome back to Credit Events. I'm really excited for us to hear from our guest this week, Adam Eagleston, who I've known for a lot of years in our business. And Adam, actually, I'm just going to go ahead and warn you right now, we're having a thunderstorm here in Nashville. So if you see my Labrador Retriever jump up on the couch and start to shake, that's what's going on. So just that'll be an interesting thing in the podcast. So when I first met Adam a lot of years ago, you were running small caps. So how in the world did you end up here on a credit podcast? What went wrong? Where'd you take the wrong turn, Adam?
I don't know. Thanks for the invite, by the way. Our chief compliance officer asked me that a little while ago, and in George Costanza fashion, I said, "Well, I guess it's on my resume." So it actually is. So unlike George Costanza, not a compulsive liar, I did have a brief stint as a credit analyst back in the early 2000s. But yeah, as you and I have talked about a little bit, despite my background in small cap, I think what that highlights is that for the large cap folks out there, you kind of take for granted access to capital. And there's a really interesting intersection of credit and small cap if you think about how these companies have to go to market, what price they're paying. And for those who think, SOFR plus 600-800 basis points is a lot, look at an equity raise and how dilutive that is and what your actual cost of capital is, and then tell me that that's too high.
Right. Equity always, if nothing else, it's more emotionally expensive.
A running joke in the office is I don't have emotions, but dilution it gets me pretty close to it. So
gets me pretty close. That's right. So, but I don't want listeners to think that you just come at this from the small cap angle. I mean, you've done a lot in your career. You've worked at bank trust departments and helped them create their portfolio platforms. You've worked at a number of organizations where you've been responsible for asset allocation, and now you're the chief investment officer for Formidable out of the Cincinnati, Ohio area, and your firm does institutional accounts. You do a lot of private wealth, some high net worth. You guys run hedge funds, ETFs. You do a lot. So we joked about you having stripes as a small cap portfolio manager, but you've been all over the asset allocation map.
Definitely have been all over the map there, and we'll talk about that, I'm sure. So yeah, was happy to join Formidable back in 2019, having been previously at a small cap firm. But yeah, I built target date funds in the past, and really Will Brown, who's our CEO and founder, started the firm back in 2013 and tasked me to really build out the investment infrastructure more holistically, put in place our investment committee structure, all those sorts of things. So yeah, even though my background has historically been small caps, I've really seen pretty much every facet of the investment industry, both from an asset class perspective as well as from a product perspective. You mentioned ETFs, hedge funds. I built collective trust funds back in the old days. So I know a little bit about a lot of things.
All right, we're going to keep trying, Adam. I told you we were having thunderstorms here in Nashville, and that one took me offline. So anyway, so we were back. I was asking you about Formidable, and actually, one of the things that you guys do there, and I've really enjoyed this, is you do your own podcast series called Tea and Crumpets. Can you tell us a little bit about that?
Well, it's funny when we lost you from the lightning there. I was talking with Chris, your producer, about that. And Will twisted my arm during the height of COVID and said, "We're doing a podcast." And I said, "Absolutely not." And, 75 plus episodes later, we're still doing it.
Wow.
We cover a wide array of topics, everything from what the Fed's doing to capital market conditions, geopolitics, all the way up to geography. We had a pretty spirited debate on the Mason-Dixon line. And I think last week we covered split infinitives. So cover a lot of ground.
That's eclectic right there. That's
eclectic, yes.
Okay, good.
What happens when both of us have English teachers for parents? So that's where you end up.
Okay. All right. Well, you've told us a little bit about Formidable. let's jump into the credit side of this, because obviously that's our axe to grind here for
Yeah.
credit events. So, talk to me a little bit about, in your role as CIO, how do you guys look at credit at Formidable? How do you deploy it for your clients?
Sure. So it's really part and parcel of our overall investment process. We're very mindful of what credit markets are doing because, again, as we talked about as it relates to small caps, it's really the lifeblood of the economy. So we are constantly tracking where investment grade spreads are, where high yield spreads are, what's that look like versus medians. We'll talk about all this more in depth later, but we're using that as part of our tactical overlay. So we're very mindful of what's happening in credit kind of more broadly. And then as it relates to something like portfolio construction, we're thinking, okay, well, based on that top-down view, do we want to be overweight credit versus the ag? Do we want to be underweight credit? Do we want to have high yield, investment grade? Like we stir all those things together as part of the portfolio construction process.
Okay. So, alternative credit has been a super hot topic in the last few years. Destra, my firm, plays in that space. Lots of folks coming in now, particularly on the private credit side of that. How do you guys look at that at Formidable? Well, first of all, let me back up. How would you define alternative credit at Formidable? Because it's not a universally accepted definition by any stretch of the imagination. And then how do you think about it, and do you even incorporate it?
We do. So it is one of those things that it's tough to define, right? It's almost like anything that's not a publicly traded asset can be wrapped into that alts banner, if you will. So in terms of how we incorporate it, it's a logical extension of our portfolio construction process. A lot of it depends on the individual client. Things like taxes, the sequence of returns, those things matter. For a lot of clients who are near retirement or in retirement, it's okay, well, how far out on the risk spectrum do I want to step as I think about fixed income? And there's also a piece of it that's simply administrative. You mentioned it earlier. You do see a lot of private credit come to the market in a public wrapper now. We'll I'm sure you dive into that pool in a little bit too. But sometimes it's just administratively, hey, we maybe really like this asset class, but it only fits for clients above X million dollars because of the toil and trouble associated with administering it from a firm perspective. So yeah, there's a theoretical piece, but then there's the practitioner's piece of it as well.
So we are in early May 2025. Interesting markets, right? Be careful what you wish for, kind of a thing, right? Very interesting markets. If we have a slowdown, I don't know if I want to say the R word, recession, but if we have a slowdown on the horizon, what does that make you guys at Formidable think about in regards to your clients and their exposures in credit? Are you worried about high yield positions? Are you thinking, hey, we should maybe de-risk? What's the outlook that you guys would have on that?
No, that's a very fair question. And again, we are very mindful of what's happening in the high yield market for a couple of reasons. One, yes, it does play into how we allocate client assets. Secondarily, we actually employ puts on HYG as part of our hedging strategy from time to time. So it's a place where the implied
very
vol,
efficient.
Yeah, exactly. The implied vol is really cheap, but if you get a very big drawdown, it can really help. As it relates to the R word, from a technical perspective, there are people far smarter than me. Torsten Slok at Apollo is laying out the case based on this sort of structural slowdown in trade because of the tariffs. Neil Dutta at Renmac, who nailed the no recession call in 2022, has become a lot less sanguine, is increasing his odds of a recession. So we're kind of mindful of that. Now, interestingly, if you look at what high yield bond spreads are right now, they're not taking that into account, right? Like, I don't think high yield bonds are pricing that. And even if you look at the peak, we hit around 460 basis points during the post-Liberation Day tumult that we had. And since then, that we've really retrenched, and we are now back down, kind of bang on line with the 10-year median. And I would argue that 10-year median is a pretty fair proxy if you think about everything that we've lived through during that period of time. I think you and I have known each other a little longer than that. But if you go back to 2015, the energy sector implosion, when you had sort of the glut, the American energy renaissance, and the glut of capital that flowed there. I think the David Einhorn Mother Frackers presentation was from that time frame. You had 2018 trade war 1.0. which led into the Fed tightening. I rang the bell on the NYSE at the end of 2018 and looked like an idiot, bringing in a bear market. You had COVID, you had transitory inflation. So my point is that 10-year period encompasses a very diverse economic background. So I think that's a pretty decent proxy for the median. But the big question we have is this time different, right? The most dangerous words, cliche. And that's really where private credit comes into play, because is that changing the overall dynamic for the composition of something like HYG, for the publicly traded high yield market? I think it might be. I think the other thing that's changing it, again, having constructed asset allocation portfolios for decades now, is the tremendous and increasing influence of passive funds like target date funds. Has the influence of those structurally lowered the long-term median? Maybe it's because the universe looks different now. I think what we've read is that a lot of the maybe you've had some upgrading because some of the lower quality borrowers can go to private credit more cheaply, more easily than public markets. I think some of the private credit has also wrung out some of the issuers where, hey, maybe they don't care as much about their rating anymore. Yeah. And maybe some of the triple Bs are now okay being double B, but they're actually better credits. And then more structurally, from a flow perspective, the target dates are insensitive buyers. So is it a new normal for high yield? I think we just don't know that yet. But I would say maybe one of our bigger regrets is if you think about the spike in spreads sort of post SVB back in 2023, is that we were waiting for, I'm always reticent to make a baseball reference since it's not my sport, but we were maybe waiting for a little bit fatter pitch based on what the history at that time would have indicated, and we never got it.
That's
so
right.
I think it's just a very different environment now. But in terms of, hey, are high yield markets pricing a recession right now? If they are based on the long-term history, we're nowhere close to that, because historically when you've had a recession, you've had like 1,000 basis point spread. We got to 460.
Yeah, I mean, the spreads are really throwing a lot of people off. I mean, you just mentioned a whole bunch of new technical dynamics that may be influencing the market. If you're just thinking from the historical fundamentals, you're looking at these spreads saying, well, nobody seems to be concerned. I mean,
right.
They're piling back into risk.
Right. What's my risk reward look like here? And you kind of think about it mathematically to some degree. And it's okay, well, what's the default rate if you get a recession? And then what's my loss rate? And that's another thing that we haven't really talked about too, but really is kind of in the weeds, is that you've had all these, essentially the lending standards have maybe you kind of the Cub Light debt, if you will. Yeah. And maybe your default rate, ceteris paribus, is the same as prior recessions, but your loss rate's higher because there's not as much protection for creditors. So thinking about the math behind reconciling, do I step out on the yield continuum or not? If your default rate's 3.5 and your loss rate's 75, okay, you just do that math and come up with like 3.5% or whatever. So that's really where you are in terms of what that spread requirement is. Is it different this time? It's an interesting question.
Yeah. Yeah. And it's also interesting to think about the evolution of what do we think in the market alternative is to credit. 10 years ago, you might have said emerging market debt or mortgages, or was that truly alternative, or was that sort of value add, sort of the plus around the core kind of a thing, right?
Right.
But this 800-pound gorilla that's shown up called private credit is demanding its attention, and it both technically and fundamentally, it really seems to be reshaping the alternative credit market.
No, I think that's well said. I think it really has structurally changed a lot of the dynamics, and you're clearly seeing it from an investor perspective too. I'm always a little reticent whenever somebody talks about democratizing someone, and I literally stumbled across that getting ready for the podcast. So you're seeing, again, at Formidable, we are very big advocates of ETFs. We like what those offer. We like the efficiency, et cetera. Having said that, there are certain asset classes where I think you don't want, I won't say the transparency, but you really, that daily liquidity works against you. And right. You need a longer horizon. That it doesn't work well inside of a daily vehicle. And I think credit is one of those places where, especially private credit, where you're seeing people trying to bring that to an ETF wrapped product. I'm not sure that's the right vehicle for that type of exposure.
Well, the impatience of investors will always drive product manufacturers to try and provide them what they seem to be asking for. Be careful what you wish for, maybe is the.
Yeah, that's exactly right. So,
Okay. All right. Well, so we talked about, we've covered a lot in just a short period of time. We've touched on private credit. We've talked a little bit about sort of the legacy, other things in alternative credit. I like what you started out with, though, was talking about the fact that as an equity investor, particularly in small caps in particular, right? Credit really is a bellwether signal for you. How do you use that from an asset allocation standpoint in the roles that you've got now more senior here, deeper in your career, where you're looking over the portfolios, not just selecting small cap equities up under them? Maybe give a little bit of the secret sauce that you use at Formidable to help with the triggers that you think matter as you're looking at credit, and maybe it's informing what you're doing over in equity.
yeah, for sure. You want to see what credit these companies are able to access, right? Like, is it asset-backed financing? Is it financing losses more generally? Do they have essentially, are they working with vendors, et cetera? So you try to figure out and triangulate. All right, well, in an ideal world, we love companies that are cash flow positive, able to buy their own shares, all that kind of thing. We're like that's the optimal, but that's not always the hand you get dealt in small cap. And the opportunity set is often in looking for the companies that are the cliche diamonds in the rough, where they've had a rough go of things, they're at an inflection point, and you can see that if they can grow into that, they've got a tremendous amount of operating leverage. But then you got to think, what does that path forward look like? And it's almost, again, it's cliche, but it's almost like taking a private equity / private credit approach to looking at the company and figuring out how they're going to get through the next 4, 6, 8 quarters from a balance sheet and income statement and cash flow statement perspective, and not dilute me as an equity holder. So you really do have to delve into not just the financials, but also you have to have pretty comprehensive conversations with the C-suite, specifically the CFO, in terms of, okay, well, how do they think about capital allocation? What levers are they going to pull? And there's also a piece of it, it's who's in the room. So you kind of look down the, not trying to beat up on the sell side here, but you look down the roster of firms that might cover a smaller cap name, and you see, okay, well, yeah, some of these firms are maybe a little bit predatory, and maybe they're going to be knocking on the door with an equity plus warrant issuance, when we would rather them go down the path of a lending relationship with private credit. And again, maybe that's confiscatory from an interest rate perspective, but I'd still rather take that versus a dilution. So again, that is really where those worlds collide in terms of small cap versus high yield / credit. And again, from a more macro perspective, how we think about it as we put portfolios together is, again, going back to that SVB example, when we see high yield spreads get really large, that's when the market is probably being too draconian in how it's pricing the loss rate and the default rate. And that's when you've got a really good chance to add some value to your portfolio by wading in tactically to something like high yield. Now, again, our preference is in that circumstance to find the right managers out there, because I think there is a huge value add in fixed income. And I think specifically in private credit, an even bigger value add. And I think especially now, probably even a bigger value add if you think about private credit, because what we're seeing now is essentially a buy or trifurcation of some of these debt offerings, where a private credit offering was sliced and diced into multiple tranches. And you better have the right manager at the table to help you sift through that, because you got to understand what your risks are for taking on that debt.
Yeah, it's becoming a more popular asset class, but it is still a fairly tight club that really drives most of the issuance in that space.
So. It is. And again, I come back to, and I think you alluded to this earlier, this democratization of access to this, and I'm quoting here, fast growing investment grade private credit market for all investors. I'm not going to tell you whose tagline that was, but you read the headlines, it's State Street, Blackstone, Vanguard, Capital, KKR. I think all those announced over the last month some type of foray into this space. And whenever you see that, again, it's one of those things that alarm bells start to ring. You think, okay, I really need the seasoned hand here to guide me through this, because this might be getting a little bit frothy. And private credit in the current form, and I defer to you here since you're clearly the expert, it's kind of been around since post-financial crisis kind of thing. So has it really stood the test of time in terms of a sustained, longer recession type of event? And I don't think it has. And I think if you were to get that, then you've got the again, the cliched, see who's swimming without a bathing suit. We haven't seen that. You know, you've had a few fits and starts of that, whether it was SVB, whether it was early April with the kind of the cracks in the facade of the Treasury market. You've had a few inklings of it, but you have not had really any wholesale liquidations. And within the past couple of weeks, you had Oaktree's CEO, CIO out there talking about some of the discounts you were seeing. You saw BDCs in early April trading at 20% discounts to NAV. So that wasn't even a specifically overly stressed environment if we think back to where we were pointing to high yield spreads. So how bad could it get in a bad environment? Don't know, but I definitely want somebody who's really doing the work for me there.
Well, there's always a chance in the current environment that we live in that there'll be more entry points provided in the weeks and months ahead, if that's the positive way of looking at it. So.
For sure, and that's our framework. We want to be patient here and find the right opportunity when we're big fans of asymmetry here. So when the asymmetry is skewed in our favor, we're a lot more willing to be aggressive. Not to make this about equities, but the asymmetry in the equity markets, not the most favorable right now. So you pull in the reins a little bit. I think credit, same kind of thing. But you don't want to be frightened. You want to have discipline here. And it comes back to, we joked about it earlier, and a lack of emotion. You want to have not a rote system, but a system in place that tells you, hey, these are the markers that we've thought about for a long time. And when we get to this point, we have to systematically start to add to this asset class, even though at the time it might be the scariest thing that you're doing, because we believe at that point the risk reward is too good to not take advantage of. And so that's the framework that we use really holistically as a firm. But I think specifically as it relates to credit, I think it's a framework that will serve investors well.
Well, that's a great point for us to close on then, Adam, and I really appreciate it. Thank you so much for your time. Before we let you go, though, I always try to hit people with this one question here for credit events. We've covered a waterfront with credit and the current market environment, but for our listeners that are credit oriented, maybe what's one thing that you think could be a surprise? It could be a prediction on your part, something that people probably aren't thinking about. If you look out through the balance of 25, what's one thing you might tell people, keep your eye open for this?
You probably can't see it. I have a whiteboard back there, which occasionally we call our hot take board. So I think you want something that would find its way to the hot take board. So with that, I would say if you do get a recession, and again, that's an if, let's just call it coin flip at this point, that and I'm kind of tying this back to the conversation about this asset class not having been stress tested in a lot of ways, that you might just get it's kind of a shotgun wedding SVB type situation where something in private credit breaks, for lack of a better word, and you have one of the behemoths step in to make sure that the integrity of that market remains in place. So that would be my, not black swan, kind of gray swan kind of thing for 2025, with the contingency that's if we get a recession.
Okay. All right. Well, I'm kind of hoping that doesn't come to pass and that we
Likewise.
Don't test that. So, but thank you so much for your time today. It's been great. I'm looking forward to the next drop on Tea and Crumpets. It's always great to listen to. And we hope to have you back again soon on credit events.
Thank you. Would love to do it. Pleasure. Thanks, everybody.
Thanks so much. Take care, everyone.